Okay, so good evening, everyone, and welcome to Almas webinar series. My name is Maulik Shah, one of the co-founder and CEO of Almas Risk Consulting. At Almas, we are in the business of managing currency, commodity, and interest rate risk for the clients. We specialize in the same, and we are a team of treasury professionals committed and passionate to work in this risk management professions. As far as today's webinar and the series, knowledge series, as I call it, is concerned, it is clearly out of our commitment and passion to spread the knowledge. But what is really making it possible is your presence. So thank you all very much for joining in from different places and participating in this webinar. And believe me, your presence here gives us that empowerment to keep doing the work again and again. So thank you all very much for joining in and your presence today. As far as today's webinar is concerned, I think last we had it on 28th of March. So the end of previous financial year is when we launched this series called Knowledge Series. And I also mentioned in that first webinar series that we had on 28th of March that our idea is to come out every time in the webinar with one topic, which we call it as ABCD of financial market. My commitment as I cover that session on ABCD of financial market is that any layman, anyone would understand what this term is all about. So basis that, the format of today's session is in the initial first 5 to 10 minutes, I will cover today's topic, which is ABCD of financial market. And the topic of ABCD is the balance of payment, which will be for about 5 to 10 minutes. After that, today we have two expert panel, both from Almas. They will share their insights. First, we will have Swaraj Rajagopal, who will talk about balance of payment, the trend over last few years, and what is an upcoming emerging trend that we can look forward to. And in the second half, which will be actually the third half, after me and Swaraj speaks on the subject, we will have our own expert on the money market, Pankaj Rathi, who will talk about the recent RBI policy, RBI monetary policy stand, the objective, and what to really look forward to. So that's really the format. We plan to complete the session in about 45 minutes. I would really encourage all of you, feel free to pose your questions anytime during the sessions. I will acknowledge that last time I missed that session which propped up on the chat box. My promise is anytime during the session, if you have any questions, any clarifications, please put it up on the chat box. In the last 15 minutes, which is 5:45 to 6, we will give the opportunity to everyone to unmute and speak. And even they can put it up their questions. So that's really the format of the session. Let me first begin with the ABCD of financial market. Anybody can decode. And today's topic is India's balance of payment. So I'm just going to take you through few slides to cover what is India's balance of payment. I will briefly explain the term and then invite Swaraj to further share his analytical observations on the balance of payment. So balance of payment is, and I will say that anything and everything that we as an individual or a household or even a corporate entity experiences, the same thing you can extrapolate to the country level. So balance of payment, as the term suggests, is nothing but balancing my overall payment. And when we say payment, it covers both the inward payment and the outward payment. So as an individual or a household, I'm sure all of you do take care of where the funds are coming in from. It could be from a current account, which could be your income, or it could be from a capital account, which could be in case if you're selling the properties or selling your shares or investments. Likewise, on the outflow side, you will spend money on your day-to-day expenditure, or you will have an investments or give a loan to anyone. That will be part of the capital. So if I were to really extrapolate the same at a country level, what we get here is the balance of payment. On one side, we have the inward payments, and I would classify that under the category called current account. So if you really see on the upper side, on the left hand side, we have exports, On the down arrow, we have a capital inward, and that is a category called FDIs or FIIs. Likewise, on the right hand side top, you see the current account, which is imports. And at the right hand side bottom, you see the outward flows, which could be in the form of either the repayment of the loan or outward remittances. Let's look at the component of balance of payment. As I mentioned earlier, we have current account and we have capital account. So what I'm going to do now is double click on current account and the capital account and look at various items that gets classified under current account when I look at the country's balance of payment. Now, one thing to clarify, when I talk about balance of payment, it is always in the context of foreign currency. So it is a transaction that happens between a resident India with the non-resident entity. And therefore, one leg is the foreign currency. So we will look at the balance of payment only in this context. Any foreign currency movement inside the country or a foreign currency movement outside the country or out of the country. Now let me take you through the component of current account. As you can see, the current account, we will have exports of goods, exports of services. There are primary incomes, there are secondary incomes. There are also invisibles. And what I mean by invisibles is there are inwards related to the travel, the tourism, the NRI flows, the services, the software services, the business services, the financial services. We may receive as a country inward or inflows on account of all of this category, which will classify under the current account, including the gifts and the remittances from our relatives overseas. Likewise, when I look at the capital account, let's look at capital account. And when I'm saying capital account, look at it from both the perspective, both inward and outward. So you may have a foreign investments. The FDI is the portfolio investment which will come in. You can have a loans which will come in. We can also have a repayment of the loan, which can be an outward. Like earlier in the current account, we can have an outflow in the form of imports or payment on account of holidays abroad or the education. Here in capital account, there are entities which will make an investments outside, which will be an outflow. So all of that will form part of the capital account. So that's really the broad breakup of current and capital flows. Now, one thing which I would want to highlight here and introduce, or rather talk about one more terms, which is very commonly used in the financial market, is the trade deficit. So we all are familiar with balance of payment, which is nothing but a difference between my net inflows and outflows. We also are talking about current account deficit, which is what we saw in the earlier chart, the net of current inflows and the outflows. And there's also another term called trade deficit. And what is trade deficit? It is only on account of goods and services. So export of goods minus the imports of goods. And given that we are negative, so we import more than the exports, the trade deficit is generally negative. Exceptionally, in few years where we have really a very low imports, which was during the COVID time. And even then also trade deficit was not negative, was never positive. So we generally are an importing nations, and therefore we will always have a trade deficit. However, with the service sectors growing in, with the invisibles coming in, we have either a current account deficit or a surplus. And that trend, we will have Swaraj who will further build on it. But that's really the broad understanding. What also further matters, and that we will take it up during the chat, the conversation, is the quality of inflows and outflows. Because for a healthy balance sheet, it's like if I have an inflows in the form of an investments, it's a very high quality. I would perceive it as a high quality, versus if I have an inflows in the form of a liability, which could be an ECB. So the quality of the flows also matters. And all of that, we will cover it in the next session while we further build on it. So that's really the broad understanding of the balance of payment. Thank you all very much for your patient listening. And I now invite Swaraj and briefly introduce Swaraj as well. So Swaraj is an Almus team member, a young and a dynamic team member who's the analyst at Almus. He is a BSc Finance graduate and has been in-depth studying all of this, the components of the balance of payments. He has made his own analysis, and I now invite him to share his analysis, observations, and then I'll get into a conversation with him. Over to you, Swaraj.
Yeah, thank you. Thank you, MS. So I'll just share my presentation first. So before getting bogged down by so many data points being flashed on the screen, I would like to just give a brief background on why this presentation. So this presentation is my effort to enable all you listeners to think about the BOP in a certain manner. So more than the data, let's understand some characteristics which are unique to India. Now, BOP, of course, has two main components, which are current account and capital account, as mentioned by MS. If we look at the current account, the one clearly evident characteristic is that it's negative. So we have mostly been a current account deficit country. Exceptional years, of course, as MS mentioned, it's during COVID. And with respect to the capital account, we have been a generally surplus country, which means we have received capital flows. But how does this translate into the entire BOP picture? If we look at BOP, which is nothing but a summation of current account and capital account, we have generally been a positive balance of payment country. Again, there are a few exceptional years, this year including. One common question or a common thought process which might arise out of this is, okay, if we have been BOP positive, does that have any implication on rupee? Well, what the data clearly shows is that it's somewhat mixed. So if we see probably FY 2008, when we had $91 billion worth of balance of payment surplus, we appreciated by 7%. If we look at FY21, when we had $88 billion worth of balance of payment surplus, we appreciated only by 4%. And this, there is of course no direct relationship between the BOP, the surplus we are receiving, and the INR appreciation. And the same thing holds true even for depreciation. So if we look at FY 2009, when we had a $21 billion deficit, we actually depreciated by 26%. But if we look at FY23, which is the current financial year, which is the previous financial year, we are roughly standing somewhere around 23 billion, and we have depreciated by 8.44%. So there is no exact one-to-one correlation with respect to your balance of payment and dollar rupee movement. So that's off the top of my head one important distinction which I wanted to make, because it's very common for us to assume that just because we are a BOP surplus country, rupee should not depreciate. But if you look at the trend, we have somewhat depreciated in most of the years, and in very few of the years we have actually appreciated. So double clicking a little bit more on the current account. Current account is nothing but your merchandise trade and your invisibles. Now, again, one important characteristic here to notice is that merchandise trade has generally been negative. Merchandise trade is your goods import minus goods export. And your invisibles is nothing but your services, transfers, and income. Services, it includes travel, tourism, your miscellaneous services like business services, IT exports. Transfers would be more like remittances, which are which don't have any quid pro quo. And if we look at income, it's when it comes to your interest payments, that becomes an outflow. And if we are receiving if the country is receiving any dividends on its investments, that becomes the income in the current account. So one important characteristic here is that our merchandise trade has generally been negative. But one important or one more positive aspect of this is that our invisibles have been doing the heavy lifting of essentially financing that merchandise trade. Because if you look at the past data, we have been our invisibles have been net positive, right? So that has been meeting roughly, if we take a median value, or 74% of our merchandise trade deficit. Again, an exceptional year is the COVID year, which is FY21, because at that time our merchandise trade reduced, but our invisible surplus was still, it definitely reduced, but it was still at a higher level. So that's why this number is highlighted more. But generally, the trend has been that 74% of that trade deficit, merchandise trade deficit, is met by our invisibles. Again, double clicking a little bit more, what is merchandise trade? Our imports have been much more than our exports. In fact, this year we have, I think, imported a record. It's a record for us because we have imported $660 billion worth of goods, while exports, I think, if we add probably a March estimate, we should be somewhere close to the previous year number, or somewhere here or there. But generally, it's been a deficit. We have been a deficit country when it comes to merchandise trade. Why is that? Again, it's an important quirk or important characteristic of India. That's energy. If you look at energy, that constitutes around 30% of our imports. So if you look at the chart on the right, it's nothing but your coal, petroleum, all of that, whatever constitutes whatever forms part of the energy basket, that comes there. And that, if you plot against the total imports, that comes to roughly about 30%. So energy is a very important number. And in fact, energy is so important that a 5% reduction from the previous, like if we take 195 billion, that translates to somewhere around 10 billion. So a 5% reduction or an increase can translate, that's a $10 billion movement in our current account, in our merchandise trade, that can happen. And it's also important to remember that our entire current account, we have got merchandise trade invisible. So, even $10 billion matter because our invisibles take care of a lot of our merchandise trade deficits. So one of the other reasons why I was showing, why I wanted to display this is that our energy, we are a very energy dependent country because we are a developing nation. Compared to the developed nations, we are consuming far lesser energy. So this energy consumption is either going to stay as it is, or it's essentially going to go up. And another factor to all of this is how the renewable story will play out. Because even though renewables has been picking up, a recent, I recall a recent article which I read, which mentioned that even though renewables is picking up, we are even set to import more amount of coal because our energy needs have gone up that much. So as a developing nation, we have a lot of energy requirements. So this particular number, this particular energy dependence is what is causing a large chunk of pressure on our merchandise trade. Moving on to the invisibles, and if I double click into invisibles, there comes services. Now services, we have got, again, refreshing what services is. Services, we have got our travel related inflows, our transport related inflows. Now transport is directly linked to merchandise trade because all the transport related incomes or expenses which happens during imports or exports are recorded in our transport section. And then we have got our IT exports, or our miscellaneous services exports, business services, communication services, and IT services. So that's again, I would say, a bright light because our total services exports has been roughly 300 billion in FY23, which is a record. And we have been doing exponentially well in our services segment of the entire current account. And I'll again double click into one more highlight, which is the software services. We know India is a IT hub. And if we just purely look at the heavy lifting which is done by the software exports, the net credit we receive from the entire service section, the software exports itself contribute 48, 49, 50% of that figure. And this figure has, of course, not been updated for FY23 because the data will be released in the coming months. But even if we take that 48%, that figure should be for FY23 should be somewhere around 130 billion. So we are doing a very good job when it comes to our software exports. And again, double clicking, if we think of software export, there are two, three heads which I would like you to take away, which is your IT services, which contributes about 62% of the software exports. Your BPO services, if you remember, even during, I think, the early 2000s BPO segment had really picked up. So that contributes to 27 to 28% of our software services export. And the rest is the export of software products and engineering services. Now, again, I'm just recapping. Our software exports are doing a lot of heavy lifting when it comes to our entire current account figures. Moving on to the next slide, which is your capital account. Now, our capital account, if we look at two major heads, which are your foreign investments, which we receive from abroad, and the loans. And as Maulik rightly mentioned, that high quality number to look at would be foreign investment, and the loans constitute your short-term loans, ECBs, all the recurring types of loans that are possible comes under the total loans. And if I were to zoom out again, if you remember, we are running a current account deficit, and we have a capital account which is somewhat taking care of our current account deficit, which is why we have a net BOP surplus. So that's the 2-3 points which I wanted you to take away. Yeah, that's it from me.
Okay, thanks, Swaraj. I have a couple of questions on the BOP and the deficit. So one quick question. So last, I think Jan and Feb, we saw trade deficit numbers below 20 billion. So till about December, we had almost 22, 23 billion dollars a month. And I'm talking about a trade deficit number. Jan and Feb, the number came down to almost 17, 18 billion dollars. Is this really one-off? Is this sustainable, because that really has a larger bearing on an overall current account deficit?
Yes. So, so is it really sustainable? First, let's understand why this number has come down. So both merchandise imports and merchandise exports both has shrunk, which is why this number has come down. And merchandise exports has shrunk faster than the merchandise exports. So one of the reasons has been government also has been trying to curtail on gold-related imports, for example. So which is why we are seeing some sort of shrinkage. But as I mentioned, for us, the major challenge remains in energy. So if, let's say, we see a uptrend in the oil prices, then the same problem which we were earlier facing with respect to the merchandise trade deficit will again start having that same problem, because energy constitutes a large part, 30%, as I mentioned. So that's a big chunk of our imports just going to the energy component. So answering your question, it's mixed as of now, just because oil has been somewhat stable in the past few months. At the same time, we are having a reduction in our oil imports. On our precious metal imports. This has resulted in a shrinkage of the trade deficit. But any moment, if let's say the oil starts shooting up again, we'll have the same problem.
So a risk of a slowdown globally will slow down export. That could be a risk. I mean, is it really a risk to the overall trade deficit?
Yes. So again, a point which I did not cover was our merchandise exports. The merchandise exports, we have got two large chunks, which is gems and jewelry, which contributes 9% of our exports, and aluminium. So both are quite, aluminium especially is quite cyclical in nature. So if we are having a recessionary scenario in the global markets, then that demand will not pick up, and that export will shrink. And that has shrunk. If we, I think, look at FY 21 and 22 numbers, that number has gone down. When it comes to gems and jewelry, I understand half of that export is diamonds, the export of diamond jewelry. Again, it's a discretionary item. If the global economy is going into a slowdown or a recessionary scenario, then that component will again suffer. So we definitely have that risk, because our major exports are either cyclical or discretionary in nature.
Okay, and another point that you talked about, the higher growth in the service exports. Now, if you really look at what happened in recent 10th March onwards, after the SVB collapse, there has been a financial instability kind of an environment. We have seen bank under stress. Now, I understand that a lot of IT companies, they have a larger portion, almost 30 to 40% of their income to BFSI sector. Whatever growth that we have seen in IT and IT services, is that under threat moving forward? And I'm asking about the forward-looking guidance.
Yeah, I think I got it. But I think one of the major things which we have to look forward to, like if we talk about the future, is how do we see this entire crisis panning out? Because I think if we just look at the discount window mechanism which the Fed has put forward to manage this entire liquidity crisis, in the recent times, if I'm not wrong, that number, the banks which have been borrowing through that discount window has come down. So it seems as of now that this entire situation is resolving on its own. So as of now, it does not seem that it's a major threat, a threat significant enough to really slow down our services exports. And if we talk about on the European part, we are having some sort of consolidation, UBS purchasing Credit Suisse. But I think it's still a one-off incident in one-off area. So till the time we are not seeing this entire crisis go out of hand, I don't think we should really bet against a decline in our software exports. Because
Okay.
we have seen that digitization has only increased. So, I mean, I don't see it as a major threat as of now.
Got it. So, last question before I have another expert on board. Is ChatGPT a threat to the service exports?
I would say ChatGPT might be a threat to one component of service exports. If you remember, around 27-28% of our the software exports comes from BPO services, right? BPO is nothing but customer servicing. And if we look at the trends recently, there has been an increase in basically chatbot related customer resolutions. You go to Swiggy and you complain. It's usually an automated chat box which comes up first. So as that chat box gets more and more intelligent, there would be a lesser requirement of a person on the other end. So that 27% might actually be a threat if the AI is able to scale up to that level. Yeah.
Okay, got it. Thank you very much, Swaraj, for your insights. Indeed useful. We have the next expert with us, Pankaj Rathi. Pankaj, welcome to the session, and you've been there around. So Pankaj is a partner at Almas. He heads the treasury and the financial market at Almas, and he himself is an expert, CA, CFA with more than 25 years of rich experience in managing currency risk, money market risk, expert in money market and forex market both. One of the rare person, I would say, or rare expert who gave a guidance of a rate pause in this monetary policy. So while the majority of the market was in favor of 25 basis points high, he is the one who said it may be a pause. So let's hear from him first about the monetary policy and then about the recent policy stance. I will invite Pankaj with an opening comment first. Pankaj, if you can talk about the objective of monetary policy, and then we can switch over to the recent policy stance which has been taken by the RBI. Over to you, Pankaj.
Thanks, Maulik. Thanks a lot. First, before I start on a monetary policy, there are a few things which I want to share on a balance of payment and the recent data. We are likely to see mercantile trade deficit lesser than 20 billion for March number also. It would be in the bracket of 18 to 19 billion dollars. That's one. Second, there is an important component which is missing from a Indian balance of payment for last 3 years. Previously, we used to get a significant amount of FPI inflows in a fixed income investments. Post-COVID, we have not got those numbers, and that can turn a BOP number into quite a positive numbers once that flows trickle in. And all of us know that there are lots of talks going on a sovereign index inclusion. Basically, India's sovereign bonds getting into a bond indices. These are the three things which will play a major role in coming times. If my sense, if really recession hits US or Europe, we can see a trade deficit numbers, or maybe at least import numbers reducing significantly, because the kind of reduction which we have seen recently, it's not coming from the quantity of the imports, it's also coming from the price. The coal prices have gone down by almost 50%. Crude oil also saw impact of a 35-40%. So these are the important variables which need to be watched before we projecting our trade deficit number and balance of payment numbers. Now coming to the basically monetary policy part, the objective of monetary policy, which had been interested by RBI Act in 1934, and that says that RBI is interested with a price stability objective. That's the first objective, while keeping its growth objective also in mind. So the first priority is given to the price stability, and second is given to the growth. Now, I would also highlight how RBI try to achieve this price inflation or price objective, stability objective. In 2016, RBI has adopted a flexible inflation targeting framework, and that has again renewed in 2021. And that targeting framework says that, and why I'm saying flexible, because it's not a fixed number. Like US targets a 2% inflation, but India target an inflation of 4% plus minus 2%. So that's why it's known as a flexible inflation targeting. The MPC constitution had been done by the parliament. There are 6 members in the MPC, and their meeting happens frequently. So these are the basically a structure of a monetary policy framework. Now RBI has got many tools, but RBI really operate through a one target, which is weighted average call rates on a daily numbers, and that should be linked, and that should be close enough to the RBI repo rates, which is a objective framework. There are quantitative way and there are qualitative way. Quantitative tools are basically, there is a LAF framework, liquidity adjustment framework. There is a LAF corridor. Now in liquidity adjustment factor, there are 3 rates which RBI targets. One is SDF, where banks can lend money, max or market can lend money to RBI. There is a repo where market can borrow from RBI, like banks can borrow from RBI. And third is a MSF, marginal standing facility. When RBI's limit on a repos has been exhausted, then you have to use a marginal rate, which is a penalty rate. And this is known as a marginal standing facility. Now, I have seen 300 basis point of a difference also in marginal standing facility from repo rate. Currently, the total LF is within the 50 basis point. So these are the few things which RBI uses for conducting its monetary policy. Yeah, what was your second question, Maulik?
No, so the related question, so one is the objective of the RBI policy and how it has really evolved. So if you look at the recent policy stance, while one is the objective of price stability and ensuring that the inflation is within the target, we have seen RBI taking a very different stand, aggressive stand, even during pandemic and even post that in the recent last 1 year. So how do you see it evolving?
So basically, let's go into a little 2-3 years back. Actually, RBI started cutting rates in 2019 itself. And the 2019, what happened is basically our inflation, CPI inflation has got hit 2%. And from that point of a time, RBI started cutting rates. Suddenly 2020 happened, RBI cut rates further and provided liquidity. And that point of a time, RBI adopted a accommodative stance. Now in coming May 2022 or June 2022, RBI moved from an accommodative stance to a withdrawal of accommodation because the inflation started going higher, and RBI continues to continue with the withdrawal of accommodation. So they have not reached neutral yet. So they want to remove the accommodative part. And I believe that in the next 2 policies, RBI will move from a accommodative stance to a neutral stance. And that's the basically I'm foreseeing that will happen maybe by June and August policy. They will move to a neutral stance, and that basically means that RBI would be ready to act on both sides.
So in the recent policy, RBI says that it's a pause, not a pivot.
Yeah.
How do you interpret this?
So Saktikanta Das made it very clear before somebody asking whether it's whether we have seen the peak of the interest rates in India. I think it's an extended pause. It's not a pivot, and why they do not want to use pivot, because The global system is so volatile at this point of a time. We don't know how many rate probably FOMC can raise or US Fed can raise. So that's the reason they have kept themselves as in a pause mode. But I believe the further increase in interest rates will require a very, very high bar. When I'm saying high bar, is basically what will happen. Suppose if US FOMC rates 50 basis rate hike further, I don't see that RBI will be raising rates. That's the first thing. Second thing, crude oil prices going higher by 10, 15, 20%. I don't see RBI raising rates. But any of these variables goes further higher, it's possible that RBI will start raising rates again. The another variable which basically primary article inflation is being hit by most of the time is the rains, seasonality of monsoons and all those things. Even if the prices, agri-commodity prices go higher because of that, I'm not seeing that RBI will be raising rates. So these are the few variables. Let me put in a different way. What happened is basically Indian OIS market, which is a derivative market, has already started discounting that RBI will be cutting rates within 1 year. And yeah, please.
Let me put the related question here. So you talked about Fed cutting or rather increasing the rates by 50 basis, we may not hike. Now, what we have seen in the last 1 year. So one is the standalone Indian fundamentals, which will prompt RBI to cut or hike or pause, whatever. The other consideration, which we saw in the last 1 year, is US hiking the interest rates. Now, naturally, as a central banker, when you see an interest rate hike in a different, in a foreign currency, and there could be a risk on your own currency, there could be a temptation to increase the rate just to fight the currency depreciation. So how do you really weigh this? In that stand of policy rate hike, how much of this is been driven by the US policy, decisions, and why do you then say the next 50 basis hike in US may not really prompt RBI to hike? So just have your view, please.
Yeah, so sure. Let me again try to put in this interest rate cycle itself. What happened is basically RBI conducted an emergency MPC meeting in May 2022. They have conducted MPC meeting in April, and by schedule they have to conduct in June also. And RBI saw that FOMC is likely to increase rates, and they came and the rates first.
Yes.
So RBI is preempting it. Now RBI currently pausing is also in that cycle. RBI is seeing that probably FOMC is raising pausing the rates and might pause in after 25 basis point. RBI preempted again. Now let me put it that RBI or basically market thinking, or let me put in 2013. What happened in 2013? When the currency was depreciating post taper tantrum, we used to see every day one circular coming from RBI on an increase in interest rates. There are some certain, maybe they will be increasing the quantum, LAF, and all those things. They were doing all kind of variables to defend the currency. But in this cycle in 2020 or 21, RBI did not raise rates. What they did is basically in 2020, first they collected the reserves, they created the reserves, and they did not want to increase the interest rate till the time they were sure that US will be raising rates. And this was entirely a play of India wanted to keep interest rates lower and nurture the growth rather than the raising the rates. So I'm of an opinion that it will be continue to do like that. Basically, RBI will preempt what US is going to do. If I think their model will be taking care of 25 to 50 basis points. Let me again highlight one more point. In last 2 years, India inflation was lower than the global inflation. Even then we raised rates. So we have got enough kind of insurance in that way to take care of our economy.
So are you then saying that no matter what US does, we will probably continue to be driven by our own Indian fundamentals? Is that the forward-looking guidance?
I'm saying that is also one of the factors, but it's not the entirely one factor.
Okay.
It's that factor is definitely there, but not entirely driven by US rates.
I have a few more questions, but before that, let me just pick up a few questions from the chat box. So Dhirendra Kumar, please share PPT after meeting. Point noted, sir. Suman Prabhu, this is related to the invisible piece. Pankaj, if you can take it up. I'm not sure whether Swaraj is around, but I'll just say Swaraj, you're there. Can you further elaborate on invisible and specify what kind of services fall under service imports? We would also like to know in which category will education expense fall. Swaraj, you want to address this?
Yeah. So,
And Pankaj, I'll come to you immediately after this response. Yes, Swaraj.
just answering that question, invisible, nothing but your services exports, your remittances received, which is your transfers, and your basically, so it's got travel, it's got your software exports, it's got your transfers. So these are the 2-3 main components of invisibles. The second part, which is what can fall under sports. So as I
Swaraj, you seem to have a bad
important
network.
because
Pankaj, are you also getting
all
this?
the expenses in logistics and also in the recent times, net if net of currency comes to travel, we have been foreign exchange with respect to travel, but after COVID, this trend has changed. So in the years post COVID, we were actually having the foreign exchange reserves go because people were going abroad and we were not receiving foreign tourists in our country. So those are the two areas where it would be considered as service imports. Educational expense, again, it's not a quid pro quo. Basically, it does not have any quid pro quo, so it will come under transfer. So whatever remittance which is sent outside, whatever remittance we receive. So net of that remittance is again a positive figure, but whatever the educational expense is considered in the debit figure. Essentially, it comes under transfers of the current account.
Okay. We have the next question. Pankaj, am I audible? Somehow I'm seeing net issues. Pankaj, am I audible?
Yeah, you're audible.
Okay. So this question is for Pankaj. Pankaj, question is from Ramana Kumar. What do you think is the impact of RBI intervention on USD INR? If BOP deficit is less than RBI intervention, does it mean rupee will appreciate in a big way going forwards?
So let me first clarify the impact of RBI intervention on USD INR. So I was just looking at the vol numbers, volatility number. Due to RBI intervention in our currency, our vols have been significantly lower. So let me put it that last 1 year average of INR vol is in the range of 5.5–6%. Let's look at this with the other developed market. The European euro vol is in the range of 9%. GBP vol is in the range of 10–10.5%, and JPY is around 12%. Our peak, which is 7.5% and 8%, is generally a bottom of these currencies' volatility. So that's the first thing. Second thing, if BOP deficit is less than RBI intervention, whether the currency will appreciate in a big way, I first doubt that RBI would be selling more than the BOP deficit. That's the first thing. Second thing, yes, if that happens, then we are likely to see a rupee appreciation, not in a big way, but definitely it will have a appreciation to the tune of 3 to 4%. That's what I assume. Because we have seen, we can see the charts also. Whenever the rupee has depreciated more than 8 to 9%, 10%, in 2–3 years consecutively, or 2 years, then a consolidation pattern or maybe a rupee appreciation pattern follows, and that's a good chance that will happen.
So Pankaj, I have the next question for you, and then we'll, in the meantime, if anyone else has a questions, they can put it up. I will also open up the box for you to raise. I mean, you can raise your hands and we can unmute you. In the meantime, question for you, Pankaj. A very recent report suggested that the banks in India, there is a significant reduction in CASA. Now we, on one hand, we just saw SVB collapse, where the current account withdrawal really put pressure on the bank and there was a liquidity issue, kind of a bank run. Here we have a report, and I know we are not same as US, both in terms of the magnitude and the interest rate hike. However, having said this, there is a CASA reduction, and that CASA reduction, do you think that can also put pressure. And CASA reduction is also explainable because there's been an interest rate hike, the move shift from bank to higher FDs or the mutual funds. So naturally, my motivation to keep money lying, which is current account, saving account, is very low. So do you really see that as a risk for the banks or banks margin?
So as you have already explained part of it, let me put it this way. Then whenever the rates are at a lower level, the term spreads would also be lower. When I'm saying term spread, the gap between the overnight of 1 year to 5 years, that would be lower. That's the first thing. Second thing, higher rates, that means basically demand of the money has increased. We will get a higher term spreads. So definitely to keep money in the current account and saving accounts, incentives disappear. People want to take risks and they elongate their maturity curve. Now, let me put it in a way that Indian banks were continuously raising fixed deposit rates. And whatever they were doing, there was a significant amount of a credit offtake was there. Recently, RBI has released a monetary policy report and which highlights that in last 1 year, weighted average of a term deposit rates have gone higher by 270 basis points. RBI has raised rates by 250 basis points. Term spreads and the weighted average has gone increased by the 270 basis points, which is a clear transmission on deposit sides also. Liability side has definitely happened, basically loan side. Now, even if I take an account of a 40 basis point increase from a reverse repo to STF rates, which is a 40 basis point, 290 was an increase and 270, which is a very good transmission. Now, whether it will happen in India, I will assign very, very low probability. And why? Because I don't believe that anything has got a zero probability. Probabilities are always there. Banking system runs on a trust, and currently Indian banking system and Indian residents believe in a RBI's ability to manage the overall so. Now, how RBI does it? RBI has got a system which says that basically you have to keep 4% as a CRR, which is a cash. 18.5% should be invested in SLR. Then there is a concept of a Basel III norm, which says that any amount which is payable within 1 year should be matched by 100% as a high quality liquid assets. So these are the few combos which are there, which is being there. Now I'm coming from a regulatory and supervisory aspect. RBI conducts an annual audit of all banks. Do you want me to compare this with SVP? I will do that. Why I will do that is, let me put it this way. In SVP, the entity, the bank was not being supervised or it's being supervised by
as you explained, Pankaj, let me also announce we are already at 5:48. Anyone who has a question and wants to speak up, please raise your hands so that we can unmute you and then you can put your questions. Yes, Pankaj, please continue.
So in US, there was no transmission of an increase in rates by US banks. They have not increased the fixed deposit rate. That's the first thing. There was no risk management. There was no supervisory authority which was supervising SVB because it was coming as a regional bank. It was a large bank, but not being supervised by Fed themselves. Their deposit base was very, very concentrated. It was into Silicon Valley, the high amount, lower number of people, a low number of people was doing that. In India, the scenario is totally different.
Got it, Pankaj. While there are no hands being raised right now, if you still have a questions, please put up your hand. You can see it on the box below, or you can even put your questions in Q&A. I will put the last questions, and if there are no further questions, then we'll end the session. Pankaj, last question from my side. Now, we have seen challenges, a kind of a crisis, the financial related instability for a brief period and then got settled. But there are challenges world over. It looks in India, we probably living in a different domain as of now. So my question to you, do you really see, India a standalone performer amidst the crisis that we see world over, or do you also see that eventually impacting us in some way moving forward? Your take on that, Pankaj.
Would you repeat question again? Sorry, I missed the critical part.
So while the world is grappling with the challenges, it seems we are so far untouched.
Yeah.
Recent numbers. I mean, you can go through the RBI report and they talk about the higher growth, industrial productions, the service growth, the airport traffic, all of that numbers are very, very positive. Now, question really is, what's moving forward the guidance? Are we really seeing we being untouched, or there will be an impact? What's your view on the market ahead?
So very recently, I think Deutsche Bank has released a report that India will be reaching a 7 trillion economy by 2030, and I will pick up some clues from there and then basically highlight those things. But before that, let me put why we are in a stronger position. It's basically, I would give it to two things. Basically, our inflation was much lower than the developed market. That's the first thing. Even we are a growing economy, we were growing at 6.5%, 7%. Other economies were growing at a 2.5%. Then also our inflation was lower. That's the first thing. And we were kind of providing positive rates, real rates to everyone. So this is one. Now look at the why we are being untouched. We are a self-sustained, a consumption economy. So we have got a demographic dividend which works for us. There is an increased participation of a women labor. So more working hands are being added to the economy. We have got a financialization of a savings, which put in lots of capital for taking further growth. Financialization of economy also says that we are moving more on a technology basis. Aadhaar, Jan Dhan account, then there is a basically digital transactions. So these are the few things which we have continuously building up. Now, building of a road infrastructure, which actually itself is adding a loss to the economy. We have reached till now is 60% of electrification of our villages. There's a miles to go which we can achieve, and we all will require a good amount of investment. And our shift in energy consumption, which all leading to basically a advantageous position to us. The other few things which I would like to say that in last 2 years, the vaccination policy of government has also worked for India. But the rest of the, let's look at the China. China was almost closed for 2.5, 3 years, but we were working for last 2 years. So these are the few things which helped us.
Got it. There is a question on the box, and Jairam Krishnamurthy has raised. Jairam has raised the hand. So first, the question from the box: how can India increase its exports and reduce its trade deficit in order to improve its balance of payment position? And what role can RBI play in achieving this goal through its monetary policy?
Swaraj, would you like to take this part of it or full?
I think Swaraj internet has it's a leg. So just check.
I think, yeah.
Pankaj, do you want to take up, please?
Okay, so basically, I think both the engines are working currently for India. On a manufacturing side, also the kind of schemes which had been launched, like PLI schemes, that will be helping India to increase their manufacturing stage. And services also we are doing much better. Now, only problem is that our external shock is basically due to the global market environment where the interest rates going higher and our currency depreciating. That's the first thing. And second thing, anything which related to energy imports, because these are the two things which are out of our control. India runs both trade account deficit or current account deficit and the fiscal deficit. Otherwise, I think we are getting into a position where basically we will be able to increase both manufacturing exports and services export. What RBI, how RBI role can play? I think RBI can adopt both an appropriate interest rate policy, which is conducive to increase growth, and basically keeping currency near to 100 or 101 RER, that will provide a good amount of impact for our exports.
Got it, Pankaj. We have a question from Jairam. Virendra, please unmute Jairam. And meantime, yeah.
Hi, good evening. Good evening, guys. So recently, RBI in their policy relaxed the rule for resident forex users to access the NDF market through gift cities. So how corporates can make use of this? This is one narrow question, and a larger question is, I mean, if you can cover it, although it may be slightly out of the subject of this seminar, what are the, in brief, what are the other benefits that corporates get out of gift city? Because this is the question that I'm also getting from many of the corporates recently. Thank you.
I think these both questions can be answered by Maulik himself.
So, while Jairam, I will not dare to respond to your questions. I would rather turn the table and put it up back to you. The first piece. Why don't you share your wisdom, sir? Please go ahead.
No, I think, I mean, my view is that there is a wider market available to corporates for hedging themselves, particularly if there are movements outside of our banking hours. And and another thing is they don't have to have actually necessarily an exchange of currencies, just the settlement being done in the net amount of profit or loss due to getting into a contract. That is what I feel. And my question was whether how they have to go about this and how best they can use it. That I'm also not clear. That is the reason why I was asking this. I'm sure it is beneficial because I think NDF market, from a time when RBI even did not want to utter the word NDF, now they said that NDF is available in India. So that is how we have evolved. Yeah,
it's a big shift, and I completely agree that it's a completely a different world in the last, I would say, 10-15 years. And it was a taboo earlier, and today they have allowed the resident entity to access the NDF market. I think it only helps creating a liquidity or a market here in India. In a way, the process is more towards bringing back those markets. While yes, I have an access, and at the same time, it gives me a wider spectrum of the instruments that are available in the overseas markets. So it's really deepening the financial market. A very, very, I would say, forward-looking circular from RBI. It moving towards a liberalized scheme of managing the forex. So I think that's really the ethos. As far as the second piece is concerned, Gift City, I think I will only add, considering the time that we have, because I want to pick up the last question from Ankit. Gift City is a subject by itself, a great opportunity, and maybe we'll have another webinar on the subject. So with that note, let me pick up the last question, which is there on the chat box. Do you think RBI building its reserves will prevent INR to appreciate even in case of a BOP surplus? Your view on this? And Jairam,
Okay,
Pankaj, let me please permit me to use Jairam now. Jairam is one of the co-founder at Almus. Jairam, why don't you just respond to this point? We have only 2 minutes.
I'm sorry.
So 1 minute for you.
I didn't get that question. Can you just...
The question is, do you think RBI building its reserves will prevent INR to appreciate, even if there is a BOP surplus?
I think my sense is that currently we see there are several macro points that have developed in favor of India, external macros as well as the domestic macros, and despite that we are not seeing an appreciation in the rupee, mainly because foreign investors have still not taken a very decisive step towards putting money into India. I mean, they are not putting money where their mouth is right now, but I guess it will change. And right now, I think RBI is also building up their reserves back to the levels we were having prior to the depreciation of 2022. And I think once I guess after a certain level, they will not be interested in holding the foreign exchange currency, particularly if the flows are. So I will keep a very close watch on how the flows are developing. And definitely, if we have seen in the past, and somehow my sense is that the second half of this year, we will see, second half of this calendar year, we will see very good flows, and it will be not a time when RBI will come in and buy. And I think we all know that once RBI moves out, there will be only a vacuum. So then we cannot say how much, we cannot even estimate where where the rupee will stop appreciating. So it can be 80 or even can be below 80 also. So scope for appreciation is definitely there. Just need to watch out for the flows.
Great. Thank you very much. And on that note, I am completing this session. Thank you all very much. All the participants, as I mentioned earlier, your participation encourages us to keep coming back with the webinar time and again. So thank you really for your interest. The next webinar will be on 9th of May, which will be immediately after the FOMC. FOMC is on 3rd of May. So the week after that, Tuesday, we will have the webinar on between 5 to 6. We will cover FOMC and other market developments and also come out with a new topic for ABCD. And with that, thank you, Pankaj, Swaraj, Jairam, and everyone, the entire backend team. Virendra is here, Kushi is next to me, everyone who has really helped in putting this together. Thank you all very much. See you next time.
Thank you, Maulik, Pankaj, and Swaraj. Well
Thank
conducted.
you. Thank you.
Thank you.
Thank you.
Thank you.